Good morning, friends. My name is Jimmy Singh. I'm broker owner of Supermax Realty, and my phone number is 647-961-2639. In today's episode, one of my clients asked me the question, since he's shopping for the best mortgage rate, one lender is giving him 1.99 fixed for 5 years versus one of the banks is giving him 2.13 variable, and he is doing less than 20% down. So I'm sure a lot of you have heard in last couple of weeks in media, the lowest rate in Canada historically is 1.99 is being offered, and a lot of people are jumping into it. So before I give you my opinion about the interest rate, I just want to go back and discuss how the fixed rate works. So for fixed rates, basically bank we will see at 5-year government of Canada's a bond yield. So basically then the government the banks basically see how much it's going to cost us to borrow the money, and then they put some spread and they put the profit on top and yield give it to the people who are looking to borrow. And historically since beginning of this year, the yield keep coming down and down because yield gives us the health of the economy. So if economy is going down, interest is also down, obviously yield is also down. And when economy keeps going up, firing all cylinders, yield increases, and so does your mortgage interest. Obviously, there's another issue of inflation, when the interest goes up. So in this video, I'm going to focus about Canada only. So Canada, oil is a big factor of our economy. So when the oil prices keep coming down, it put pressure on the bond yields, and the bond yield also come down. And last couple of weeks, if I see a little bit uptick on oil prices, the yield also get a little bit stabilized, right? And second thing is stock market. So when the market crashes, all the investors run. They take their money, they put in security of a government 5-year bonds, or and get a decent yield on it. But when the investors start putting money in government bonds, the yield also comes down. So historically, yield is very low. That's exactly the reason you are getting fixed rate, which is like 1.99. And now coming to the answer, question, should I take 1.99 fixed or should I take 2.19 variable? What is my thoughts? So guys, first thing is you have to understand the difference between the two is only $27 a month. And even in like 5 years, the interest you're gonna pay is only $2,612. I did the calculation based on 500,000 loan for 25-year amortization at these interest rate, right? So I was talking to my client. I said, listen, you see what COVID have done to economy. If you lose your job within the term, so let's say the term is 5 years. After 2 years, you lose your job and something happens, you have to understand how much the penalty you're paying. You already know you are ahead $2,600 if you get 1.99 versus 2.13. But I did some calculations. So typically the banks take greater of interest differential or 3 months penalty. So in this case, in fixed mortgage, if he breaks the mortgage within 2 years, then the bank is going to say, hey, I gave you discounted rate of 1.99, and in 2 years time, he's going to see his term is left 3 years, and whatever is the posted amount that day, they're going to charge penalty on it, not on 1.99, probably 2.84, 2.6, whatever is in the future. And his penalty might account to $23,000 versus if we pick another lender and pay him 2.13 in variable interest rate, his penalty would only be $1,900. So you see, here is basically $23,000 and here is $1,900. So he will be saving $20,000 roughly in penalties if he choose variable with 2.19 interest versus going fixed 1.99. And again, this advice is only for people who know their job is not stable, life is not stable. But if somebody is secure, they should by all means take 1.99%. And lastly, he asked me the question, which person get the best interest rate? So here is my thought. When you're doing less than 20% down, you are actually paying CMHC premium roughly $10,000-$15,000, and that basically premium goes to CMHC to secure your mortgage. So in case you default down the line and your house goes power of sale, CMHC protect the lender. So lender will always give the best interest rate to the people who are doing less than 20% down. Like people think, I'm doing 20% down, I should be getting more better interest rate since I'm less risky. But that's not the case. Banks perceive differently. They feel if you're doing less than 20% down, you're paying, premium of insurance, and they are more secure. Versus if somebody is doing 20% down, they feel, you're doing 20% down just to get rid of insurance, but it adds extra risk to the portfolio of the banks, so you will pay a little bit higher interest. So in conventional mortgages, somebody who's doing more than 20% down, and if you can afford to, I tell my clients do 25, 30, 35% down. You will get better rate than the person who's doing 20% down. And also, if you're buying, investment property, though your credit and everything is good, you will always pay more interest versus your primary residence, because banks consider as little risky. I hope you like the video. If you like the video, visit my channel, Real Estate with Jimmy Singh. Give it a thumbs up, subscribe for the next videos. And I hope you enjoy. Stay safe, stay healthy. God bless you. Thank you so much.